Your next reading is currency and exchange rates. The first OLS says define an exchange rate and distinguish between nominal and real exchange rate and spot and forward exchange rate. First of all, exchange rate is the price of one currency in relation to another. Like right now, as of today, $1 is equal to 155 PKR approximately. So we can write it as PKR 155 per dollar, right? So 155 PKR, $1. This is the price of one currency in terms of another. It can be given in opposites. So the base currency is always set equal to 1, in this case $1, but it could be either shown as a numerator or denominator, totally up to you, the way you want to go about it. So that's the idea. The exchange rate is the price of one currency in terms of another, and this is the base currency that could either be represented in the numerator or denominator. Next part is the real exchange rate. Well, this is the spot rate, right? The exchange currency rate right now, this is spot rate. When we say the real exchange rate, so it is similar to the spot exchange rate, but it also incorporates varied price levels between two countries, because countries have different price levels due to inflation, so the rates will be affected accordingly in a different way. Then forward exchange rate, as the name suggests, spot exchange rates are the rates for the currency exchange right now, but forward exchange rates are for exchanges at a future date. So rates are agreed upon today for an exchange of currencies that will take place at a specified date in the future. This is what you call the forward exchange rate. Okay, the next LOS is describe the functions of and participants in the foreign exchange market. First, businesses in global perspective. Firms that do business in different countries are exposed to fluctuation in relative values of exchange rates over time. So foreign exchange markets allow for hedging these exposures we discussed in our previous readings. So they also allow for investors to take positions to take advantage of expected changes in rates over time. So these are the participants in foreign exchange market. First, corporations. They buy goods and services in different markets, so they need payments in different currencies. They will receive payments in different currencies. So it allows for transactions in multiple currencies. Real money accounts. Investments from mutual funds, insurance companies, and pension funds who are limited in how they can use derivatives. This is the second participant. Governments, of course, many government agencies make foreign transactions. And finally, the central bank. Central bank use foreign exchange market transactions to influence and affect the domestic exchange rate. Next LOS is calculate and interpret currency cross rates. Currency cross rates allow you to interpret exchange rates for different currencies using multiple rates. For example, right now, as I said, $1 is equal to 155 PKR. In the same time, $1 is equal to 3.751 Saudi Arabian Riyals. Now, if I want to calculate the cross rate between Saudi Arabian Riyal and PKR, what I can do is, like, I want to calculate PKR per SAR. So that will be PKR per dollar times US dollar SAR, which means I have PKR per dollar, that is 155 PKR per dollar, and if I just do it in the reverse, it's going to be SAR per dollar in the denominator. So it's going to be 155 SAR per dollar, just taking the reciprocal in the denominator, that will give you 3.751. So its simplification will give you the cross rate between PKR and SAR. That is 41.32. That means that one Saudi Arabian Riyal will get me 41.32 Pakistani rupees. And this is the current rate. 1 Saudi Arabian Riyal is about 40.99, roughly same amount. So this is how you calculate the cross rate. Your next LOS is convert forward quotation expressed on a points basis or in percentage terms into an outright forward quotation. First of all, your forward rates can be expressed in several ways. One of the ways is outright forward quotation, which basically is actual rate for the transaction. Second is percentage terms. So forward rate can be expressed as a percentage of the spot rate. And the third way is forward points. Basis points of premium, basis points of discount to spot rate. Let me explain this to you. First of all, basis point is equal to 1/100th of 1%. That is 1/100 of 1%. That's what you call basis point. Right? Therefore, 100 basis point, if you say 100 basis point, so that is basically equal to 1%. So let's do interconversions. Let's say given spot rate is $1.6459 per pound. Right? And this is the spot rate, and a 6 months forward rate is given as negative 12.7 points. Of course, clearly it's a discount given in discount basis point. Now let us convert them into outright forward rate. So what you're going to do, 1.6459, since it's negative 12.7 basis points, you need to divide it with 10,000. So when you net this off, you will get 1.64463. So this is your outright forward rate. Had it been premium, you would have added this. So this is how you convert your spot rate into forward, by adding or deducting the basis point of premium or discount on the spot. And then if you have to express them in percentage terms, what you do, 1.64463, this is the forward rate, expressing the forward rate as a percentage of spot, 1.6459, and whatever the result comes, deduct 1 from it, you will get, if you simplify this, and I'm rounding off, this will give you negative 0.00, almost 1%. Right. Next reading, explain the arbitrage relationship between spot rate, forward rates, and interest rates. First of all, since different countries will have different interest rates, so their respective spot and forwards rates are constrained by the relationship in their respective rate differences. So an investor, what he can do? An investor with the investable capital and he has access to foreign markets, he has two options. Either he invests in dollars within the US and receive the domestic risk-free rate by investing within the US. Or what he can do, the second option, he can invest in foreign currency, receive foreign risk-free rate, and then have to convert back to the local currency at the end of the period. So the relationship that we can use to calculate how much arbitrage profit he can make is this. Forward upon spot is equal to 1 plus interest rates foreign over 1 plus interest rate domestic. So using this, I will show you in the next slide how we can do that. All right, let's take an example. Let's say the interest rate in the US are 5% and interest rate in UK, let's say, is 3%. Let's say for the sake of simplicity, current exchange rate is 1 US dollar is equal to 1 British pound, for the sake of simplicity. Now, what a British investor can do, he can convert his 100 pounds. Well, let us take the first case first, domestic. So let's say he has 100 pounds. So he simply takes these 100 pounds and invest in the UK at 3%, which means after 1 year, he will receive pound 103. This is the first option. What he can do, the second option he has, he can take his pounds, this UK-based investor, he takes his 100 pounds, converts them, since the rate is $1 to 1 British pound, so he will convert these 100 pounds into dollar, so he will be receiving 100 US dollar, right? And now he can invest this $100 in the US at 5%, which means in the future he will receive $105, right? Now what he will have to do, he will have to convert this $105 back into the UK, right? So what we expect the forward rate to be, just applying the previous formula, forward upon spot is equal to 1 plus foreign interest rate upon 1 plus domestic interest rate, right? So we want to determine the forward rate. So F, the current spot is 1 on 1, so it's going to be 1, then 5% foreign, so it's going to be 1 plus 5% over 1 plus 3%. Now if you simplify this all, what you will get, the forward rate will come out to be 1.01942. These many US dollars per pound. This is going to be the forward rate, right? Now, when he converts these $105 back into pounds, let's see how much he receives. 105 upon 1 point, this is the forward rate, 1.01942. So the result would come approximately 103 British pound, almost the same. It was basically 102.99, but he will receive 103 points. So whether he invests locally within the British pound at 3%, or he converts at spot, invest in the US at 5%, when he converts it back, so this is going to be the rate. So whether he invests locally or whether he invests internationally, his payoff would be the same. But if there is any differential, he can make some arbitrage profit. Next, we have a couple of parity theories. First, the Fisher effect. The Fisher effect tells us interest rate differences between countries, interest rate domestic, interest rate foreign. So the interest rate differences between countries are due to differences in inflation between these domestic and foreign currencies. So the country that will have higher interest rate, let's say here, a country that has higher interest rate experiences higher inflation. That's the Fisher effect is all about. Then we have interest rate parity. Interest rate parity states that the differences between interest rates in two countries is the same as the difference between spot exchange and the forward exchange rates. And the third one is the purchasing power parity. The purchasing power parity is the principle that the rate depreciation in one currency, it will be roughly equal to the excess inflation rate in one country over another. So this relationship tells us an investor would come out the same whether they invest at domestic risk-free rate or at a foreign risk-free rate and convert through the exchange rate. These parity theories are discussed in your EOCs, so you will have better understanding once you do the questions. So I'm just giving you the overview here. Calculate and interpret a forward discount or premium. First of all, the basic relationship is forward premium is in fact when the forward rate is greater than the spot rate, and there would be a forward discount when the forward rates are less than the spot rate. So the formulas that are involved is current forward rate is equal to current spot into 1 plus interest rate foreign over 1 plus interest rate domestic. And when the forward is trading at premium, in that case the forward trading premium would be equal to current forward rate minus current spot rate, and vice versa if there is a forward trading discount. So trading premium would be when the forward rate is more than the current spot rate, and forward trading discount would be the case when your current spot rate is higher than the current forward rate. Let's do an example to explain the point. So we have two hypothetical currencies, ABC and XYZ, and are trading at the spot rate of 1.60 ABC per 1 XYZ. If the interest rates in ABC's country is 7% and 5% in XYZ's country, and the actual 1-year forward is 1.62, identify any arbitrage profit opportunity if it exists. So let us first apply the formula we just learned. Current forward rate is equal to current spot rate multiplied by 1 plus foreign interest rate over 1 plus domestic interest rate. Now plug in the numbers. Current spot is 1.60. Foreign rate is 7%, that is 1.07, and then the domestic is 5%, 1 plus or 1.05. So when you simplify, it's going to be 1.63. Now this is interesting. This is the actual 1-year forward, 1.62. This is the current forward rate, 1.63. Since the actual forward rate of 1.62 is lower than the arbitrage free forward rate of 1.63, an arbitrage opportunity exists. And so we can earn arbitrage profit by buying the forward contract at 1.62. Next is calculate and interpret the forward rate consistent with the spot rate and the interest rate in each currency. First of all, the spot market currencies are exchanged for immediate delivery in the forward rate market, whereas contracts are made to sell or buy currencies for delivery in the future. Let's take an example. Let us consider when a company in the US, it buys from England and the items bought are priced in pounds, right? So the importer in the US, it owes British pounds for the future deliveries. Now what an importer can do, the US based importer, the importer can be protected from this risky exchange by quickly negotiating a 90 days forward contract with the bank. So what will happen? In 90 days, the bank will provide the importer with the nominal amount, while the importer gives the bank the agreed rate. And this US based importer then can be protected from exchange rate volatility. Well, within this context, let us discuss the interest rate parity. According to interest rate parity theory, the currency of a nation with lower interest rate, let us first take the example. Previously, we discussed an example where the US rates were 5% and the rates in UK were 3%. And the exchange rate was 1 to 1. 1 pound is equal to 1 US dollar. Right. So according to interest rate parity theory, the currency of a nation with lower interest rate should be at a forward premium in terms of the currency of the nation where the interest rates are better. So this can be related this way. That is forward minus spot. This could either be positive in case of forward premium or negative in case of forward discount, is equal to spot into interest rate foreign interest rate domestic over 1 plus interest rate domestic. Let's plug in the numbers. Spot is 1, that's just 1. Interest rate for foreign, that is 0.05. Interest rate domestic 0.03 over 1 plus 0.03 is going to be 1.03. So when you will simplify, this will give you 0.01942. So this is going to be the forward premium, that is $1 per pound. Okay, then we have described different exchange rate regimes. Exchange rate regimes basically describe the policy by which a given country manages its exchange rates relative to other currencies. So there are 3 regimes. Let us discuss briefly. Floating rate regime. Floating rate regime allows for free floating of exchange rates over time. So the central banks may intervene occasionally to influence the rates if the value changes too much. So they have to control the currency. Next is pegged rate regime. In the pegged rate regime, exchange rates are pegged to another currency, just like in Saudi Arabia. $1 is pegged at 3.7451 Saudi Arabian Riyal. So exchanges are pegged to another currency. Government intervenes regularly to maintain exact exchange rate. And then we have a floating peg regime. Basically, it's a hybrid approach that allows for some movement in exchange rate, but within a tight constraint. This is often used by countries transitioning from a pegged regime to a floating regime over time. Your next LOS is explain the effects of exchange rates on countries' international trade and capital flows. First, changing prices of currencies. Well, foreign currencies change in value due to domestic economic trends. So these price changes impact supply and demand of currencies between currencies. So for example, if a country is doing well economically, so change in that currency's exchange rate will affect the supply and demand of currencies between other countries with which it trades. Increase in demand for imports. When domestic income rises, people have more money. So in that case, the demand for imports also rises. So in this case, investors will invest in other countries when they see favorable interest rate differences. Then we have prices of products being expensive. Some countries are more reliant on imports than on domestically produced goods. So for such a country, a devalued currency makes imports more expensive. In continuation to previous slide, self-correcting tendencies. When a domestic currency is strong, when the US dollar becomes stronger, it will make imports look cheaper. So in this case, imports will increase, but exports will become more expensive for the foreign country, so exports might fall. But that trading over time will cause the currency to devalue it, so as more is spent on foreign currency. So this is called self-correcting tendencies. Then development of trade deficit. A strong domestic currency, like if US dollar has become stronger, it will lead to more imports and fewer exports. So this creates a trade deficit as the trend continues. And then finally, effects on standard of living. Currency values affect the ability to buy imports and export your products to the foreign country. So a country with no demand for its currency will suffer in its trading relationship with other countries. And it will result in limited trade opportunities, it will hurt domestic growth, and it will limit consumer options. And thereby, the standard of living will deteriorate.